How did the stock market recover quickly after Black Monday 1987? Imagine waking up to a world where stock prices suddenly plummet and chaos seems to take over the financial markets. That was the scene on October 19, 1987, known as Black Monday. Stocks around the globe crashed, with the Dow Jones Industrial Average dropping over 25% in a single day. It was a shock that left investors worried about a deep economic downturn. But surprisingly, the market bounced back fast. How did that happen? Well, the answer lies in quick and smart actions by the Federal Reserve and other major central banks. As soon as the crash happened, the Federal Reserve made it clear they would step in to keep things stable. They lowered the interest rate on the federal funds from 7.5% to below 7%. This move made borrowing cheaper, encouraging banks to lend more money. They also used special tools like reverse repurchase agreements to inject cash into the Treasury securities markets. This meant more money was available for banks and financial institutions to use. The Federal Reserve also reached out directly to big banks, urging them to extend credit to prevent a credit crunch. They even supported key financial firms, like the largest options clearinghouse in Chicago, to keep the markets functioning smoothly. These quick steps helped restore investor confidence. People saw that the government was serious about preventing a total collapse. The coordinated efforts with other countries like West Germany and Japan also played a role. Their central banks eased monetary policies too, which helped stabilize the global markets. The market's recovery was rapid. By the Wednesday after the crash, the S&P 500 had regained 58% of its losses. This was an unusually fast rebound compared to other crashes. The underlying strength of the economy, despite the sudden drop, also helped. Investors realized the crash was more a correction than a sign of deep economic trouble. The Federal Reserve's swift response, along with international cooperation and the market's resilience, prevented a long-lasting downturn. This episode shows how important timely and coordinated actions are in managing financial crises. It was a clear example of how central banks can step in to contain panic and support recovery after a major market disruption.